Hello everyone. The month of September for the bond markets, I would say was nothing short of a roller coaster ride. We had a lot of turbulences both on the interest rate front as also on the credit markets. Alongside that, even the macro numbers, which is the crude oil prices and the INR, which is the rupee, was appreciating, that is crude on one side appreciating and the dollar rupee on the other side was depreciating. So these were creating a double whammy from a bond market perspective. We saw yields go all the way north of 8.2% and crude oil prices go past the $80 per barrel region, and dollar rupee also zoom past the 73 to the dollar. So I think the confluence of all these three factors led to lack of apathy in terms of demand for the bond markets. The foreign portfolio investors continued to be net sellers in the month of September as well, and looks like they need to see some stability both on the currency front and also on the rates front to be able to come back with some meaningful confidence. On the domestic front, something similar. We have not seen too much of appetite from domestic institutional investors, largely because there have been concerns lingering on how much higher can crude oil prices go and how much lower can the INR trade. The good news amid all this is that we saw a borrowing program cut on the total government borrowing program for the second half of the financial year, which acted as, I would say, a small saving grace for the bond markets. Additionally, in the month of October, the Reserve Bank of India announced an OMO schedule, which is open market operation purchase of bonds to the tune of 36,000 crores, or in dollar terms close to about $5 billion. Now, along with this number, the total OMO done by the Reserve Bank of India would be in the region of 86,000 crores, or close to $12 billion. Now, a combination of the borrowing program reduction and the announcement of open market operations is likely to give a slightly, I would say, support for the long bond yields, especially on the sovereign side, which has been under visible stress for a fairly long period. The last monetary policy happened on August 1st. Since then, till date, on the date of the policy, we have seen yields on the long bonds inch up by almost 0.5%. Another good news was that in the Monetary Policy Committee decision, the committee voted for a status quo on the rates, which means that contra to the market expectations of a 25 basis rate hike, we actually saw a status quo, which means India's repo rate stands at 6.5%. The change in stance from neutral to a calibrated tightening is what has been communicated by the policy statement. How did the markets react? We saw yields come down when the monetary policy decision was made. The 10-year was trading at about 8.15%, which went down to a low of about 8.2%, and it has been trading or hovering thereabouts. What we believe going forward is that the 10-year will likely trade range bound as a fallout of status quo on rates and open market operation, which is purchase of bonds, and third, a reduction in the total supply with a borrowing program cut. A combination of these three, if you superimpose a stability in crude oil prices and INR, could be an icing on the cake, and we could see a small rally in the near term, We, however, rule out a very significant fall in the yields given that globally interest rates are on the rise. How could the currency behave? Very immediately after the policy, we did see currency take a setback and trade beyond the 74 to the dollar region. It is important to realize that we have seen back-to-back 2 rate hikes in June and in August, and hence the RBI maintained a pause in this policy. Needless to say that they will continue to watch the data points and take a call if incrementally the next rate action, which in this case seems to be a hike, will be in the month of December or probably in the month of Feb. For now, expect range-bound trading at the long bond end, but given the enhanced liquidity in the system, we expect the shorter end of the yield curve to gain some respite. This would meaningfully give a small, I would say, breather to the markets after a tumultuous series of uptick in bond yields led by credit events in the Indian bond markets. What could be the strategies to focus on in this kind of a market scenario? We clearly believe that investors, whether domestic or foreign investors, these bond yields continuing to be at elevated levels provide a sweet spot to gain some ownership of Indian bonds. One could look at making core allocations to the short end of the yield curve, but shying away from this market scenario is not something that we would suggest. One could consider staggering investments depending on the segment that one wants to prefer, but we clearly suggest that one could start looking at making allocations given that the next rate hike, things being constant on the macro front, could be at least 2 months away. On that note, happy investing. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.